last week we started the week in volatility. We got a little spike in volatility. This week we're right back down to the average. We're almost right smack dab on the average. This is the worst place to be as an option trader. It's funny because we spend a lot of time planning on volatility getting back to this point, but when we're finding new trades, what we really like is these volatility extremes. We love it when volatility is really high up here because it's easy to make the assumption that it will drop back down low. Options are expensive, we'll sell high, and then hopefully never have to buy back later, or if we do, buy low. And then when volatility gets very low down in this area, it's easy to make the assumption that volatility will rise and get back to that average because volatility has a central tendency, or a property that you've probably heard the phrase returns to the mean, return to the mean, and that's why I put the 4-year average on here so we can see volatility, how it does return to the mean, and when we buy low and sell high, it gives us an advantage. So that's kind of what we're looking for. But right now, it's difficult to when the volatility is right at the average for the market in general. The market gets really stubborn when we're looking for new trades. It doesn't want to give us too many advantages. So we have to find stocks that don't necessarily follow the market. All right. So right now we don't have a strategy that's easy to find advantages. It doesn't mean that they're not out there. It just means we have to look a little bit harder. What I want to talk about this week is the implied borrow rate. So I'm going to talk to you about what the implied borrow rate is and
Brian?
Yep.
I do have a question for you.
Sure.
If you do take some money on margin, is that the same thing as a borrow rate? When you're
That depends. So the borrow rate specifically is related to the interest rate that you would pay or be paid on when you're borrowing stock to sell short. So your margin treatment as far as the, your broker putting up half to buy stock or things like that, that's a margin, that would be just called the margin rate. So borrow rate is different than margin rate, but your margin rate is something that you want to be aware of because you do pay interest on the money that you borrow to invest on margin. Okay? And those details are going to be different with every broker, so each broker is going to have different fees and sometimes different fees for different people because your credit rating is, important, how much money you have to invest, those kinds of things, how much experience you have in investing. All those things can affect those rates. But borrow rate is not so much affected by your credit rating or anything like that as it is by the stock itself. Okay? And so, and that's what we're going to talk about. That's a great question. Great question, Pat. All right. So when you take a short position in the stock, you have to borrow some stock from somebody who owns the stock or somebody who has the stock. Like you're borrowing from a credit union, right? If you borrow from a credit union or you borrow money from the bank, you have to find somebody who has the asset that you want to borrow. And then before you can sell short the stock, you have to borrow it from somebody to sell it with the promise that you'll pay it back, right? So when you borrow stock to sell short, there is an interest rate involved, and it is called the borrow rate. Now, the actual borrow rates are a closely guarded secret. There's just, you're not going to find a website that's going to give you the actual borrow rate. It's like a closely guarded secret. So you won't necessarily know what that rate is until you see the charge come out of your account, right? But thanks to the relationship we talked about a little bit last week about the put-call parity relationship, how the put and the call at the same strike price should have pretty close to the same time value. And thanks to that relationship, we can calculate an implied borrow rate. Okay, so we can kind of figure out what that borrow rate is, what that borrow rate is likely to be. And our data provider in Odds Online has that data for all of these stocks in our system. And Odds Online scans for implied borrow rates. The proprietary scans are things you're not going to find anywhere else. We have a positive implied borrow rate scan and a negative implied borrow rate scan. So the positive implied borrow rate, now this is one of the things that's going to be a little different than going to the bank and borrowing money for a car, right? You can actually be paid to borrow stock because firms that are loaning the stock, they want to hold your cash as collateral for the loan. So you put up some cash to borrow the stock and or your margin, and they want you to put that cash into their escrow account so that they can do something with it. And if the stock that you're borrowing is a stock that's easy to borrow and it has a low risk to loan, then you can actually earn money, earn interest on your borrow rate. So you can sell short the stock and actually earn interest by doing so. That's kind of weird, isn't it? You're getting paid to borrow money or borrow stock from someone. Positive borrow rates are bullish indications for the stock. So that means that if the borrow rate is positive, the stock is super easy to borrow. There are people that want you to borrow so that they can hold your cash, and then they can use your cash to do other stuff, and the stock is easy to borrow. It's low risk for them to loan it to you, and that is bullish for the stock. Okay, so a positive implied borrow rate scan will show you a list of the stocks that have positive borrow rates. Negative implied borrow rates. So when the stock becomes difficult to borrow, the firm is going to charge you an interest rate to borrow the shares because they're taking on a risk. It's a little bit more risky for them to loan you those shares, and the stock is more difficult to borrow. So as it gets more difficult to borrow, the borrow rate goes up. And the more negative the borrow rate is, the implied borrow rate is, the more bearish indication it is for the stock. So in the community, you'll see me talk a little bit about a few different stocks that have negative borrow rates that show up all the time. And those stocks are just heavily shorted. They get very difficult to borrow. Implied borrow rates they're complex calculations that are derived by analyzing the differences in the put-call parity relationship. When we have a model of prices and how it works, the put-call parity is a way to check to see if your model is accurately predicting things right. And when that put-call parity relationship gets a little skewampus, there's some mathematical adjustments that you can do to it to try and even things out. So when you look at the implied volatility of a put and the implied volatility of a call at the same strike price, they should be pretty close to the same, but they can be quite different. And so the implied borrow rate, the way that they calculate that difference is they adjust the interest rate component of the model to find out what brings the put and the call back into parity when they make those adjustments. And that gives them what the implied borrow rate would be for that particular stock when the put call parity gets out of balance. So if the actual numbers don't add up to time value being 0 plus the same on both sides, they can do a calculation to say what the implied borrow rate will be. So positive implied borrow rates tell us that the stock is easy to borrow and the risk for the loan is low. That's bullish for the stock. Negative implied borrow rates tell us the stock is difficult to borrow and the risk for the loan is high, and that is bearish for the stock. Now, odds online scans for, as both these scans, it'll just scan for whatever the implied borrow rate is, both positive and negative. But it also looks to find the most negative implied borrow rates. And I think that this is one of the most advantageous things that the implied borrow rate can give us, is it tells us which stocks to just completely avoid. Right? We don't want these in our portfolio at all, in options or in stock. And the stocks that we talk about, like Tilray, TLRY, Beyond Meat, BYND, those are the stocks that are just habitually on here. They're just heavily shorted stocks. They're just really heavily shorted stocks. And it's so expensive to borrow these shares to sell short that it takes away the interest rate that you'd have to pay to borrow these shares. It takes away the opportunity that you have if the stock does go down. They'll offset each other, and you're not expected to really make anything if you sell short the stock. So it becomes really expensive to sell short. Now, if you buy puts on them, the reason we know that the borrow rates are so high is because the puts are ridiculously expensive in time value compared to the calls. So you're going to pay way too much for those puts if you're trying to make a bearish bet. Now, some people have asked, and some people will say, well, then why don't you just sell calls? Because the put-call parity relationship is so big, the calls are just not worth selling. You're taking on a risk. It's not worth selling. Because of that, you can't really make a bullish bet. If you wanted to buy the stock, you might not be able to sell the stock later, and the stock is planning to drop in it. So the probability of you making any money by trying to do a bullish bet is extremely low. And it's like, well, why don't I sell the put options? Well, the stock is headed down, and that's how you lose with increasing volatility. So there's just no way that we've found in our analysis of looking at a bunch of these stocks over time. There's just no way to profit from the idea that you know the stock is likely going down when they get a really high implied borrow rate. If you are looking and you see that, because we've seen a couple of times Beyond Meat and Tilray show up on the Strata list every once in a while. And I just ignore them completely. Don't want them in my account. Don't want to fiddle with it. There's just no way to profit from it because it's too expensive for us to make a good bet. Okay. So the most negative implied borrow rates occur when demand to borrow shares for short selling is extremely high. Now, I don't know if you know about this either, but there are limits to the number of shares available to borrow. So there are rules about how many shares can be borrowed to sell short. And sometimes, and in fact, a few times when I've tried to do a risk-free trade that required short selling of the stock, I went to try and put the position on, found out there were no shorts available. Couldn't borrow the stock. So I didn't do the trade. So when this happens, the put-call parity can get substantially out of balance. And you might look and find the call at the same strike price has a time value of $1, and the put at the same strike price has a time value of $6. It gets completely out of balance, and that happens. Okay. What we do with odds online frequently is we will scan the market and look at every stock, and we'll break it up into 10 groups. The 10% at the top of the data and the 10% at the bottom of the data. And in this case, we're looking at decile 1 is the worst of the implied borrow rate, which is a different scan. And so, and that's this scan right here. So you can see negative implied borrow rate, decile 1, stocks to avoid. So if I go to scans and I look at the proprietary scans, click on negative implied borrow rate. And then at the top, there's a link right here that just says stocks to avoid. Click on that, and that brings up my list of stocks that I don't want these in my portfolio at all, in any way.